The first step that we're going to work our way through is development of a ProForma income statement. The ProForma income statement provides a projection of the anticipated profits over some period in the future. In this case, we're going to be looking at a projected period of 6 months, and to project this income statement forward, we have to go through 4 steps. We're going to, number 1, establish sales projections in concert with marketing. Number 2, determine a production schedule in concert with operations people, which will include the new material, direct labor, and overhead that we need. Those two together, the sales and the expenses information, will lead us to gross profit, the gross profit number, and then there are going to be some other expenses that we have to consider as well in the income statement. And from that, we will actually develop the actual pro forma statement. So let's look at an Excel schedule that pulls all of these tables together. Okay, there we go. For our purposes of our analysis, we're going to assume this corporation, call it Goldman Corporation, has 2 products. Those products are wheels and casters. So we're going to be operating with 2 products throughout this, and we'll do several things twice. If we had a firm with only 1 product, we would only do these things once. The first thing we're going to do is gather some projections about what level of sales we expect to have over the next 6 months. And this information is likely to come from the marketing department. We are expecting to sell 1,000 wheels and 2,000 casters, and the sales price on each of these, for the wheels it's $30 and for the casters $35, which means we're going to have revenue of $30,000 for the wheels, $70,000 for the casters, and $100,000 in total. Now, we are going to assume that these are sold on credit. So we're granting credit. The fact that we've sold $100,000 of product doesn't mean we have $100,000 in cash coming in the door simultaneously. So that's one of the things that we'll have to work our way through, is how to convert from the sales numbers to the cash receipts. The next thing we're going to need to do is to convert that sales information into a production schedule. So the production schedule that we're going to be looking at, we're going to need to determine the number of units that will be produced. The way we will do that is by starting with the beginning inventory levels. So we don't need to produce things that we already have on hand. We're going to need to produce, so we will already have that available. We're also going to need to produce enough to project, to meet our sales requirements, and in the end we're going to have some desired level of inventory. So let's look at all of those together. Okay, so to determine the production requirements, we're going to take the projected sales. We need to produce enough to sell those. We need to produce enough to have some ending inventory left. We don't need to produce things that we've already produced, so we're going to subtract off the beginning inventory, and that's going to leave us with the production requirements that we have for this 6-month period. So let's bring this back up. We're going to need to know the beginning inventory, and we're just given this. We're not computing this. This is a given. We are given that there are 85 units of inventory for wheels and 180 for casters currently, and let's work back a second. We need to make a change here. This is not a sales price. This is actually the cost of each unit, and therefore the total cost. So this is cost per unit, and that's not table 4.4. And this is the total cost. And this is the total for both of them added together. So let's go back again. We had the quantity of 85 and 180. It's costing us $16 per unit to produce these, or it cost that in the past. $20 per unit to produce the casters, which means in inventory, which we're going to assume we're on a FIFO basis. We're doing FIFO here. The total costs are going to be $1,360 and $3,600 respectively. If we look in this cell, we would find that we're just adding up those two cells, the sum of those two, as you can see here at the top. Oops. I seem to be wanting to, that area up there, which it doesn't want to allow me to get into very easily. But you can see up here in the area that's C11 to D11, we're just summing those two together to get the total. Once we know the total beginning inventory and just as importantly the number of units that we have, we can then move toward table 3, which is our production requirements. Remember, we need to sell. We'll just look at the wheels for right now. Let me remove that arrow. We need to sell, or we need to produce the amount we're going to sell, 1,000 units, plus the desired level of ending inventory, which we're going to assume that we want to keep 10% of our unit sales for this 6-month period. So this is just a given. This $100 is a given. It's not being computed anywhere. But we want to produce enough to sell 1,000 units plus have 100 in stock at the end. And we want to, but we already have produced in the past 85 units, which is our beginning inventory. So in the end, the number of units that we want to produce is 1,015 for the wheels. Likewise for the casters, 2,000 plus 100 or plus 200 minus that 180. So the numbers of units that are being produced comes from our sales information as well as our beginning inventory and our desired ending inventory, just as we showed in the PowerPoint slide earlier. We need some information about unit costs, so that's the next step. Let me clean up a little. There we go. So our costs, remember originally in the previous period we had costs of $16 and $20 for wheels and casters respectively. Here we're going to assume in table 4.4 that our materials costs are, well, to begin with, notice that the totals are different, so costs have gone up. since the last period, and those costs are being divided among materials, labor, and overhead as follows. Let's just deal with wheels for right now. The materials cost is $10. The labor cost is $5 per unit. The overhead is $3 per unit, so a total of $18. We'll go through the same methodology for the casters, and on the basis of this we're going to develop our total production costs. So these are the costs we're going to incur per unit. The number of units we're going to produce we found in table 4.3, so we now have 1,015 units at a cost of $18 per unit. The total costs are $18,270 for producing wheels over this 6-month period. For casters, the same methodology, 2,020 units at a cost of $22 per unit gives us $44,440, and the total cost is this $62,710. Let me clean up. Okay, we now know what our revenues are going to be. We projected those in table 1. We know what our costs are going to be. The next thing we're going to do is develop a table to allocate the manufacturing costs and determine the gross profit. This is reasonably straightforward. Let me pull this. I have some other tables here. We'll just track where they feed in. I might need to make a little more space. Get everything on. The gross profit here in table 4.6, we simply pull the quantity sold. If we go click on this cell, we see it's referencing B3. You see this up at the top up here. It's referencing B3, which is this cell right there, the quantity sold. So we'll just work our way down for the wheels example. The revenue material for wheels, quantity sold, sales price, sales revenue, 30,000. The number of units, looking at the cost of goods sold, we have $85 of original units priced at $16 a share. Because we're using FIFO, those are the ones that go out first. An additional 915, which is just the difference between the 1,000 and the 85. So 915 units at our new, where was it? At our new price of $18 a share. So our total costs, then we simply multiply 85 by 16, we get 1,360. The 915 multiplied by 18 gives us 16,000. Our total costs of goods sold are 17,850. And our gross profit then is 12,170. We do exactly the same thing for the casters. The casters, let me clean up just a moment. We'll go through the process just so that it's clear again to everyone. The casters, we have sales information. We have $70,000 in revenue. Our costs, because we're on a FIFO basis, the first 180 units cost us $3,600. Our second 1,820 units, which is simply 2,000 minus 180, 1,820 units, are priced at $20 per unit. That's the cost. Rather, the cost is $20 per unit. We multiply those together and we get $40,040. We simply then add $3,600 and $4,400 to get $43,640. And we're able to calculate the gross profit in both instances for the wheels, for the casters, and then the combined amount sits out here to the side, $38,530. At this point, it's worthwhile to calculate an ending inventory number, which we're going to need in developing really the balance sheet later on. To do that, we're going to start with the beginning inventory that we had. We're going to add the total cost of producing new units right here. And then we subtract off the units that were sold. So through the cost of goods sold, that comes here, and our ending inventory then is going to be $6,200. Throughout the this analysis, though, there will be a number of items, several numbers that are in yellow. When you see something in yellow, that just designates that later on we're going to end up using that information in developing our pro forma balance sheet at the very end. So this is one of the items that will go into developing that pro forma balance sheet. The last item that we have here is actually to develop the pro forma income statement. Let me slide it up here just a little bit so we can get it on the screen well. This pro forma income statement, we have sales revenue, we're really pulling this information from table 4.6 above, where we calculated gross profit. Sales revenue minus the cost of goods sold, total cost of goods sold, leaves us with gross profit. That's the first three items here. After that, those are all related to the operating activities of the company. There are several other expenses that we are going to have in the income statement, but they aren't related to the operations per se. General administrative expenses, in this case, estimated to be $12,000. Interest expense, estimated to be $1,500. And after we go through that, we start here at gross profit, or earnings before interest and taxes. Well, here's our earnings before interest and taxes at the operating profit. So we have the gross profit, subtract off the selling and administrative expenses. We'll find ourselves with earnings before interest and taxes, or operating profit. The next things are interest, and then taxes. In this case, we estimate them to be 20% of the earnings before taxes. So we take this 25,030, multiply it by 20%, and that is the 5,600 number. That leaves us with earnings after tax, and normally we would just end right there with our income statement, but we're going to pay some dividends, and while these are not an expense for computing earnings, they are definitely a cash flow, and we need to recognize that it's going to impact the balance sheet. So we're going to go ahead and go one step further and calculate how much retained earnings is going to increase. It's going to increase by the amount of earnings less the dividends. So we're going to subtract, in this last step, subtract the dividends from the earnings to get the increase in retained earnings. It's designated in yellow again because, as I mentioned earlier, we're going to end up using that in the balance sheet, the pro forma balance sheet later on. Let me clean up. Okay, there we have this cleaned up. Now we've developed a pro forma income statement. We did that by first projecting sales, using that information to estimate what the production requirements would be. To do that, we had to look at what the beginning inventory, the ending inventory, the beginning inventory we had, the ending inventory that we want to have, and we developed the production costs in that manner. The difference between basically the sales that we generate and the costs of doing so, or the gross profit, which is the first step in producing this pro forma income statement, which is the last thing that we did. If everything goes as planned, and things rarely do, but if everything goes as planned, that pro forma income statement will look like the actual income statement that is developed over in the accounting department when June 30th comes around. The next thing we're going to have to do is we're going to take this income statement information and translate it into cash flows. So that's really the next step, and to do that we will look at a new set of tables. That's really the end of this section, so we will start back here in the next section.